Assalamualaikum and hi. My name is MAWADDAH binti Ali. My tweet number is 074623. Today I want to present about our selected topic, which is the interconnection between ESG integration and exchange rate volatility in Indonesia and Malaysia. In Southeast Asia, notably Indonesia and Malaysia, ESG factors increasingly linked to currency stability. Indonesia, Asia's largest economy with strong ESG integration, still faces exchange rate volatility from global factors. Malaysia shows a similar pattern. Understanding how ESG progress impacts their currencies help policymakers and investors leverage sustainability for stronger, more resilient economies in our ESG-focused world. The economic overview of Malaysia and Indonesia from 2022 to the first quarter of 2025. Indonesia maintains steady GDP growth around 5%, supported by strong domestic and record high foreign direct investment of USD 4.3 billion in 2022. Inflation declined from 6 to 1.7 by late 2024, while the interest rate was capped at 6.25%. President Prabowo continued ESG-focused development policies. However, the Jakarta Composite Index dropped 7.1% in early 2025, reflecting rising investor concerns amid global uncertainty. Meanwhile, Malaysia recorded a strong GDP growth of 8.9% in 2022 due to the tourism recovery after COVID-19. However, growth slowed to 3.6% in 2023 due to global inflation, before rebounding to 5.1% in 2024 driven by the shift to renewable energy. Inflation dropped from 4.7% in 2022 to 1.5% in early 2025, with the central bank maintaining the interest rate at 3%. Politically, Prime Minister Anwar Ibrahim's unity government ensured stability and promote investment. The analysis of the relationship between ESG and exchange rate dynamics in Malaysia and Indonesia from 2005 to 2025. Between 2005 and 2010, both countries showed about 2% increase in ESG scores, but currency values were mainly driven by internal factors such as commodity prices and global investor confidence. ESG had little direct influence on exchange rate stability. From 2010 to 2015, scores continued to rise by over 4%. However, both the Malaysian ringgit and Indonesian rupiah depreciated sharply due to global factors like US monetary policy and falling oil prices. Between 2015 and 2020, ESG improvements remained steady but currency fluctuations persisted. This was mainly due to inflation, global economic uncertainty, and trade disruptions. Finally, during 2022 to 2025, ESG scores increased again by around 2.18%, yet both countries still experienced exchange rate volatility. Indonesia's rupiah was affected by political uncertainty and global shocks, while the ringgit faced pressure from foreign monetary policy. In conclusion, while ESG performance has improved, it does not have a direct or immediate impact on exchange rate movements. Exchange rate volatility in both countries is still mostly influenced by global economic and political factors. The past 2 decades, both nations show steady improvement in their ESG scores, reflecting stronger governance and a growing commitment to sustainability. However, despite these advancements, their currencies remain volatile or depreciate during several periods. For example, from 2005 to 2010, where ESG scores rose slightly, Malaysia's ringgit appreciated steadily but Indonesian rupiah fluctuated sharply, driven more by global commodity price and by ESG progress. Between 2010 and 2015, both countries made significant ESG gains, yet their currencies weakened due to external pressures like US monetary policy and oil price crashes. This trend continued through 2020 and beyond. ESG scores kept rising but exchange rates remained unstable due to inflation, political shifts and global market dynamics. In summary, the data shows that while ESG growth supports long-term sustainability and may influence investor confidence, it does not have a direct or strong impact on currency performance. Macroeconomic and geopolitical factors remain the dominant drivers of exchange rate in emerging economies like Indonesia and Malaysia. In conclusion, our analysis of Indonesia and Malaysia shows that while both nations have made commendable progress in ESG, its direct impact on exchange rates is limited. Currency movements are overwhelmingly driven by global commodity prices, interest rate, and geopolitical shifts. ESG plays a vital role in long-term economic resilience and investor confidence, but for immediate currency stability, traditional macroeconomic fundamentals remain paramount.